Welcome to another edition of the McAnulty Method, where we're joined by financial expert Frank McAnulty, who's going to share his financial wisdom and knowledge with us so that we might live a smarter and better financial life. We're also joined by Colin Sorrells, who's bringing his own brand of wisdom and knowledge. And gentlemen, thank you both for joining us.
Thank you.
Thanks, Bill.
Today, I'd like to hear something that we hear more and more about, which is inflation. Inflation is coming, and that's what they keep saying. So, if indeed inflation is coming, where are some good places to put your money during a time of inflation? Frank, why don't you kick us off?
Well, I have been looking into this because it does seem to be worry, in spite of what the federal government is telling us, that inflation is only transitory and we're not going to have any. Everywhere you look, prices are up, and it doesn't appear they're going down anytime soon, which is, to me, is the definition of inflation. Usually with inflation, there's two things. You look for hard long-term assets that, in order to replace them, it's just going to cost more. So if you own them, they're going to go up in value. Real estate being, as you know, one of my favorites. And then I was also looking for stock investments that, what stock investments do well in inflationary times? And the answer is those that have pricing power, which may sound weird, but it's like companies where people just have to have the product. And if they need to raise their prices, they can raise their prices because you have to have it. And that used to be utilities, the phone company, power company, gas company, things like that. But one of the examples they used was Apple.
Huh?
Apple. Because people that buy Apple have to have Apple. And they'll buy whether the price goes up or not. So yeah, it is a worry. Although every time we have big reports on inflation or worries, it lasts about 13 seconds, and the market just goes, we'll worry about it later. But I really do think fixed assets, real estate, having your own home. People will say gold, silver. To a certain extent, yes, but I'm not a huge fan of that. There's no return on gold or silver. It can go up and down in a heartbeat. So, Colin, what do you think?
I'm fully on board with real estate. I agree with you on gold. It's basically price to inflation. It goes up in value if, it becomes more expensive to buy things. Generally, there's nothing underneath it. My question to you, though, you talk about real estate, which I know very common way to hedge against inflation. We've already seen the housing market sort of explode over this past year, 18 months. And so I'm wondering if this is sort of a unique situation with inflation and the fact that there's a lot of people that think these houses are already overpriced.
Well, you've got to, like usual, you've got several different opinions on that, and you're right. It's funny. The cost of the house is not really the biggest factor in this. It's the price of the land. What are people willing to pay to live in a certain place? And that does bring up an interesting conundrum, is that the reason real estate prices are so high are because mortgage rates are so low. Because people are now buying houses the same way they bought everything else in their lives. What can we afford to pay? And so with lower mortgage rates, we can afford to pay more. So we'll pay more. Of course, now what happens when mortgage rates go up? Well, price of the house may have to come down because people can no longer afford the payments. But here's the deal. If you lock in a 30-year mortgage today at the ridiculous rates they have of 3.5, whatever they are, whatever they're advertising on the radio to get back, that rate will never change on you over the next 30 years. So it doesn't matter. Inflation can go to 10%. Mortgage rates can go to 10% after you buy. Sure, the value of your house will go down a little bit to start with. But then when mortgage rates come back down, that'll change. And also people's incomes will go up because theoretically, with inflation, they're going to have to get bigger raises. Companies are going to. So it, as with most economic things, it's not simple. There's no straight line. But I think rather than sitting and having your money in cash in the bank where you know you're going to lose money, okay, I'm earning, let's say you could earn 1% in the bank, which I'd be happy for you to show me where you can earn 1% in the bank, and inflation goes to 10%, well, you just lost 9% that year, which is starting to be real purchasing power. So, I think that's why inflation scares people so much. It's what's going to happen? What's going to change?
No,
Now, I was going to say, what about something like a real estate investment trust?
Well, that's a good way for regular people to get into real estate. So let's face it, we talk about buying a house. Okay, it's California. You need $120,000 down, maybe $60,000 down just to get a decent condo somewhere. A lot of money. You want to invest in a investment package where you only have to put 25,000 in. They require you to be an accredited investor, which means you got to have $1 million. Okay, great idea, Bill. Go into a REIT, an apartment REIT, some sort of building REIT where they own the real estate for you, and you can buy the shares at $50 a piece. So you're putting it into a hard asset through the company. I think that's a great idea.
yeah, and it's like you said, the affordable way to get in. I kind of wanted to get back to, you brought up your point about leaving cash and maybe switching the conversation, not just from where you should put your money, maybe some ideas of where you should not put your money. And I think cash is one of those. I hear when people say that, hedging against inflation, I was like, you sit at the bank, inflation, if the money you're losing and what they're getting in return are not offsetting each other, otherwise it's not inflation. So, you just leave it in a bank. I know people don't even leave it in a bank. They just keep it at home. This is the worst of everything. But I think one we talked about, another place that's sort of a topic, when I say sort of, a pretty big topic of conversation, I think, when this whole inflation deal comes up at the college level, is the TIPS. And I brought them up to you. These are these Treasury inflation protected securities. And the basic idea is they're supposed to rise with inflation and fall with deflation. But it's all based, from what I understand, on the consumer price index, which, Frank, as you point out, is, if you want to use the word subjective, it's not a perfect measure of inflation, though. And so maybe not getting accurate exposure to inflation. Maybe your tip is there's inflation going on, but you're not getting the return you're supposed to be getting because it's not perfect.
Well, we can't let perfect be the enemy of doing something.
It's true.
Because even a tip, let's say even if the tip only pays you half the inflation that's going on, that's still better than basically none of the inflation that's going on that you get from a bank. People worry about being perfect. I mean, even the biggest money managers in the world lose money now and then. They make the wrong choice, but they are doing something to grow their money. And I think that's the problem. Of course, we're going back, we're talking mainly about college college age people here, you're not sitting on $100,000 in the bank. So okay, so my money goes down a little bit. But I think it's more to develop the mindset that, okay, we gotta start doing stuff. We got to start getting into the habit of thinking, okay, is this helping me in the long run? So we've shown it's not about tomorrow. It's not about next year. It's about 20 years, 30 years, 40 years, where these little things you do today are going to make a huge difference in the future due to compounded interest.
No, that's a great point. I think when you talked about stocks and certain stocks, but my understanding is that actually in the long run, most stocks benefit from the idea of inflation, as opposed to, I see a lot of people say, oh, they're a good long-term inflation hedge, but there could be some rocky roads in the short term.
Oh, definitely. Because a lot of people, they may be, their money may get tight. They may not be able to buy as much stuff.
Right.
In
But
the
it's
short
that
run.
idea of let's think long term here. Inflation is going to mess with things very much so in the short term, but it's setting yourself up, I think, is the point we're making here. Where are we going to be 5, 10 years from now?
Right. You're not doing this for tomorrow. You're not doing this for next year. You're doing it for the long. If all you cared about was tomorrow, well then okay, I got $100. I got $100 tomorrow. Who cares?
All right. So we'll take the long view on all this. And I think, however, that our time has come to an end. So I'll ask you guys, any last thoughts? One sentence to wrap it up?
Well, let's close it out. Let's say we said real estate, right? We said gold. If you didn't want to, would you say gold is more about not losing than actually gaining any money in inflation?
I would say so.
Yeah. So, real estate, gold if you're very conservative, right? You talked about stocks, right? Something, electricity, water stocks, something where Apple, I can't even see that, but I'm not delusional, I guess.
But you're right. You brought up a good point when you said water stocks. Some of the best dividend paying stocks are water stocks because you can't live without water. It's really that. And while they're a public utility, public utility commissions let them raise prices as their costs go up. They allow them to keep their margins, so they're going to keep making money because you can't have the water company go out of business. You can't have the power company go out of business. You can't have the gas company go out of business. So yeah, it's thinking about, okay, who's going to be able to continue making money under these scenarios?
Absolutely. Yep. Biggest needs people have to, yeah. Well, I want to say Apple so badly because that'd be the first thing I'd get rid of if I needed money. But that idea, maybe I don't need a brand new car. You still need gas for the car you have, but you don't need the brand new car this year. You'll wait a year, you'll wait 2 years, whatever. And then I think the last thing we talked about was REITs because we talked about real estate. REITs offer you that opportunity to get in with less capital. So
Right, especially now that you can buy one share of stock that you want
that's right
at a time. I guess through Robinhood you can buy fractional shares, but that just seems silly, especially if the stock's at $50 a share. Save your pennies and buy $50 worth of stock at a time. But so there are ways. Let's see what would be. And I never even looked at it, never even thought about it because I try to be positive. Okay, what do I need to invest in? Not what should I not invest in? I'll have to look into that next and see what they say we should stay away from.
There you go. But you've given us some good ideas on what we should look at, and certainly water. You can't live without that. Colin, you were talking about, hey, I'm going to buy a new car, but I got to buy gas for this one, so maybe some commodities, and the REITs. So this sounds like something we should revisit in a couple of weeks, depending on what happens next. But in the meantime, I guess we're going to wrap it up for this time around. And I want to thank you both for joining us. And we'll see you both next time on the McAnulty Method.
Okay, thanks,
Have
Bill.
a good one.